I believe in long-term investing and financial freedom, and a big part of that is being as tax efficient as possible. Unfortunately, 2026 is going to be the year HMRC comes after more ordinary people than ever before. And the worst part, most people who get one of those dreaded brown envelopes haven't done anything intentionally wrong. They're not criminals, they're just caught in a net that's getting bigger, tighter, and more advanced every single day. Today, I'm going to explain why 2026 is the tipping point, what HMRC has built behind the scenes, and how you can protect yourself. But I'm also going to show you something far more powerful: how smart, long-term investing is the legal way to build wealth while reducing the tax you pay. Why 2026 is the breaking point. There are two reasons HMRC is switching into attack mode. Reason one, their new AI surveillance system is really powerful. HMRC has spent billions building technology that can now track PayPal, Apple Pay, Google Pay, eBay, Etsy, Amazon, Vinted, sales, crypto exchange data, rental income, overseas assets, even your social media posts. They call this system Connect. It pulls data from banks, platforms, foreign tax authorities, property records, and more. And it flags anomalies automatically 24/7. Gone are the days where you could fly under the radar. Everything is digital now. Reason two, the government needs money, and HMRC is the quickest revenue tap. Fines, penalties, interest, late submissions, incorrect submissions. When you look into it, this is their most lucrative business model. If you want to join other like-minded investors, by the way, all trying to be as tax efficient as possible to build wealth, see below and you can join my investing community on Skool. Who HMRC is targeting next? This won't probably come as a big surprise, but the HMRC has realised something. The easiest people to target are ordinary people who don't know the rules. So the main groups being flagged are small online sellers, landlords with like one property, freelancers and side hustlers, ordinary crypto traders and investors, people selling second-hand goods, tutors, designers, photographers, coaches, literally anyone earning outside PAYE. Most of these people don't even know they need to declare income over £1,000, and HMRC knows it. That's why they increased nudge letters, phishing campaigns and auto flagging. They don't even know if you've done anything wrong. They're just casting a wide net. And now this info is according to my accountant, who is chartered, and someone along with his uncle who I've trusted since having a limited company back in 2012. Making tax digital. The penalty Goldmine. From April 2026, every self-employed person and landlord earning over 50k will have to submit quarterly digital records through approved software. Miss a deadline? Fine. Make an error? Fine. Wrong format? Fine. Not digital? Fine. HMRC doesn't expect to collect more tax, they expect to collect more penalties. This will push many small operators back into PAYE, which is exactly what HMRC wants. This, by the way, is not me giving out financial advice. I'm just trying to help you with my investing experience in general financial knowledge. For more specialist advice, speak to a suitably qualified accountant. How to protect yourself right now. The good news, most people can protect themselves with 3 simple steps. Step 1, document everything. Keep records, keep receipts, track income and expenses. Even a clean Excel sheet is enough. Being prepared makes you the wrong target. Too much hassle for too little return. Step 2, understand tax efficiency. Most people panic when they see £3,000 undeclared income. But if your cake business had £3,000 in sales and £2,500 in legitimate expenses, you only owe tax on the £500 profit, not the £3,000 revenue. HMRC knows most people don't know this, and they take advantage of it. Step 3, be proactive. Register for self-assessment if needed. Know the 1,000 trading allowance. Prepare as much as possible now. And if you have an accountant, make sure they're competent. Now let's flip the script. How you win the tax game. This is the part HMRC never advertises. What a shock. You can't avoid paying tax on income, you can't dodge reporting rules, you can't hide from the digital net, but there is one place, the only place as far as I'm aware, where the government actually rewards you for being smart. Long-term investing is your legal tax break. While they tighten the net everywhere else, ISAs and pensions have never been more powerful. Why? Because these accounts allow you to grow wealth completely outside HMRC's reach. If you want to know how to invest in the stock market step by step and how to invest inside your stocks and shares ISA or your SIP, self-invested personal pension, see below for a recent playlist. Summary. The HMRC is tightening the net and 2026 will be messy for a lot of people. But if you understand the rules and you use the tools we do have, you can build wealth untouched by the fines, penalties and surprise letters. So stay smart, stay protected, use ISAs, use pensions, invest long term and don't pay a penny more tax than you legally owe, because wealth isn't built from side hustles alone. It's built from what you keep, not just what you earn. This video is to hopefully give you a little warning and to nudge you towards long-term investing. If you're not sure how to invest and you need a little bit of help and support, again, you can join my investing community on Skool. The link can be found below in the description.